Money 101 with Bob McCormick. The news you need and the information you can use. Now, here's Bob McCormick.
We're on every day from 10 to 2 on Money 101. You owe back taxes. What are your options? In the next 10 minutes, you're going to find out. Can your tax debts be wiped out? What can the tax man go after? We're going to answer the question. What is a revenue agent as opposed to an IRS agent, and why you need to know the difference if you owe taxes? And is a taxpayer advocate going to help you? Plus, if you end up in U.S. tax court. I'm Bob McCormick. Dennis Brager, state bar certified tax specialist. Welcome to Money 101. Dennis, good to see you.
Nice to be here.
First off, what is the difference between an IRS agent and a revenue agent? Because I assume the revenue, is the one that collects the money?
Well, actually, there are a few different titles that are used. There's a revenue agent, and that's the fellow or gal who comes out to your business and does the audit. There are office auditors who work on smaller cases, and you come down and meet with them for the audit. They're revenue officers, and the revenue officers are somebody who actually goes out there and collects the money, knocks on the door, levies on the bank accounts, that kind of thing. And finally, there's the person you definitely don't want to meet, and that is the special agent. And a special agent is the one who investigates criminal cases for the IRS. They have a gold badge. They will always show it. And if one of those folks comes to your door, the only thing you want to say is, a pleasure meeting you. I need to speak with my lawyer.
All right, let me ask you, though, who gets that kind of treatment?
The way you get into criminal trouble with the IRS is generally not just by filing a false tax return, but doing it intentionally. And the IRS can't climb into your head and figure out whether you did it intentionally, so they look for what they call badges of fraud. And those are things like lying to the revenue agent. There are things like hiding your assets.
Is filing a false tax return worse than not filing at all? I mean, there's a lot of people that don't file tax returns. We get them calling all the time.
It absolutely is. Although, as Wesley Snipes found out a while back, filing a tax return by itself can land you in jail. But, I think he was a special case. The average person who hasn't filed their tax return basically just needs to get them filed, get into an agreement with the IRS, and get that thing. Okay.
Well, you mentioned something called hiding assets. It's been a big deal right now. They've been going after Swiss bank accounts, bankers that have been turning over names of people. These people aren't necessarily in trouble unless they don't pay what is said they owe. But what's the difference between hiding assets and going to a legitimate country like Switzerland or another island offshore and depositing your money there?
Well, there's nothing wrong with depositing your money in Switzerland. The problem comes about is that most people who put the money there for one reason or another don't report the income on their tax returns. And also there's a special form that those people are supposed to file. It's called an FBAR, Foreign Bank Account Report. They need to file it every year. And the penalties are just horrific for not filing.
Okay, even though the money that profit, the interest or whatever on that account that's offshore was made offshore, you need to pay taxes to the U.S. government?
That's right. We have what they call a worldwide taxing system, different from a lot of other countries. And it doesn't matter where you make the money. If you're a citizen, if you have a green card, if you live here, you need to report that income on your tax return.
Right. Dennis Brager with us on Money 101, KFWB. Bob McCormick here. I mentioned if you owe back taxes, you're not likely to end up in this. But unless you owe a lot, and we're going to get into that. But I'm concerned about the stories I've heard about a lien placed on a home or a business for back taxes. Is it happening more frequently now? Because we know the state of California needs money. We know the U.S. government is supposedly cracking down.
Well, I don't know if lien filings are up. As a matter of fact, if anything, they're probably slightly down because the IRS has agreed to work a little more closely with taxpayers who owe relatively small amounts of money. But if you owe more than $50,000 or so, one of the first things the IRS is going to do after they get beyond the preliminary conversations about, getting this thing paid up is they're going to slap a lien.
Well, can they freeze your bank account?
That's called a levy, and it's a little bit different. Right. And they go out and they can certainly grab your bank account.
They can't take a retirement account, can they?
Yeah, they can. If you have access to it, like an IRA, even though you would pay a penalty to pull the money out, the IRS can go in and grab that. Different for the state of California. They can't.
California can't, but I've heard the state of California is more aggressive as a tax collector.
They are indeed more aggressive. That's mostly been most people's experience. They're more aggressive. But the thing about the state of California is they operate more on a one-to-one basis, and if you've got an issue, it's easier to resolve that with an agent. They have more flexibility, I would say.
Well, they can actually make a decision and say that they don't have to go to another higher up.
Right. It's just more flexible.
Okay. We've heard a lot about people settling their bills for pennies on the dollar. If somebody owes, and I take it if it's in this category of criminal wrongdoing, false tax returns, ain't no way they're going to get a pennies on the dollar resolution.
Generally not, but there have been cases where people have actually been convicted of tax crimes, and years later they're able to go through this process and get some relief for the debt. I mean,
they go back and get some of the money back?
No. In other words, if a case is criminal, you could wind up going to jail. But going to jail doesn't wipe out the debt. You still
have to pay the money.
You still have to pay the money.
Can you usually pay the money to stay out of jail?
No.
Dennis Prager, Money 101, KFWB, News Talk 980. He just said your bank account can be seized. We'll find out about the California Franchise Tax Board and their new program and what you need to do if you owe money. And if you can settle your tax settlement, what's the key to success? Find out next on Money 101. I'm Bob McCormick, KFWB, News Talk 980, home of the Los Angeles Clippers.
Money 101 with Bob McCormick. The news you need and the information you can use. Now, here's Bob McCormick.
Coming up in the next 10 minutes, what you need to know about the United States Tax Court. And does the IRS or the Franchise Tax Board, do they get a little more aggressive if you hire a lawyer to represent you? When do you need a tax attorney? And we'll be answering those questions and more. Let's go to Morris in Hollywood on Money 101 on KFWB. Dennis Prager with me. Hello, Morris.
Yes. My question is, how do you get to settle? IRS last year sent me a letter that I owed them just short of $170,000 for the tax year 2011. And how do you get to settle that?
Well, could you tell us the story a little bit about how you $170,000?
I apparently received some notice from Wells Fargo Bank regarding some investment I had, and my understanding was I didn't have to report it, and apparently I do, and I did. And so they came back after me, and the reporting penalty was like $26,000. The penalty, there was an additional penalty of almost $17,000. The interest was almost $14,000. And I contacted them, the tax attorneys that you hear advertised on radio, and they wanted some outrageous amount to handle this, and I thought that was just out of my hands.
All right, well, let's talk about this. You got a $170,000 tax bill. Dennis Prager, what's the first thing you're going to ask?
I think the first thing I would ask is I would want to take a look at those penalties that have been put on there and why they were put on there. Those penalties may be negotiable if you had reasonable cause. So, for example,
you were told that you didn't have to pay taxes on it by somebody at the bank,
right? Or did you have an accountant or a tax preparer prepare your tax return for you?
Yes, but it's my fault. I didn't give the tax preparer the information to report it because I was under the assumption I didn't have to report it.
Okay. All right. Well, you might want to look at the IRS's offer and compromise process. You can go on their website, and they have actually a calculator where you can walk through the calculations of whether or not you would qualify. And essentially, what the IRS is going to be looking at is, can you afford to repay that? I mean, if you have $200,000 sitting in the bank, they're going to say, sorry very much, write us a check.
We want the whole thing.
Right. But if you own a home, there's very little equity in it. You've got a job and you're making $35,000 a year, and you gotta pay your mortgage or whatever. You have to go through those calculations and figure, is this a good deal for the IRS as well as you? Because it's a business deal for the IRS.
Now, you mentioned having the money in the bank, liquid assets. What about he owns a home free and clear? Is that in the same, they view it the same way, or is that because it's his principal residence that's kind of off limits?
No, it's not off limits in terms of these offers and compromise. They might not seize and sell the house. They might give him an opportunity to pay it off, pay the debt off over time if his only asset is the equity in the house. But the first thing they're going to do is ask him, well, can you go borrow some money against the house? We want to see you borrow the money.
Got it. When you are given bum advice, let's just assume that Morris was. Does he have a case? Can he go and could you sue? I take it you can sue anybody. I mean, we live in this litigious society, so it's kind of a silly question to ask. But would a suit against a financial advisor that gave advice that got him a big tax bill, would that something that you think as a lawyer would have some grounds?
The short answer is, yeah, this person in that situation would probably have a good lawsuit, but what they're not going to be able to recover is the back taxes. I mean, the taxes would have been the same whether or not the bad advice was given, but
still owe the tax regardless of that. Okay, that's
right,
the bottom line.
Yeah, but the penalties, there are substantial penalties, as Morris was talking about. You could recover those. You could recover the interest that the IRS is charging, and perhaps all the fees that you paid to a CPA or an attorney to sort it out for you.
All right, Morris, good luck to you on that. As you just heard Dennis say, go to the IRS.gov website and look at that offer and compromise and go through there and see if you might qualify. And doing an offer and compromise, is this something you can do on your own? Or he mentioned, and let's get right down to the nitty-gritty, because there are tax professionals all the time who are promising big reductions in debt, and he just said he had a demand for an outrageous upfront sum of money. Now, do tax lawyers or the tax advocates that you hire do this on contingency, or is it upfront money? And if they're not successful, man, you're just out of luck. You're going to owe even more.
Generally, they don't do it on contingency. Some firms charge a flat fee. Others charge on an hourly basis depending upon the amount of time. And what I would say is, if you go to somebody and they promise you the moon, make sure they can explain to you how they plan on getting there. Because unfortunately, there are a lot of people out there that are, selling dreams.
You mentioned the difference between a revenue agent and a tax specialist.
A tax specialist is not somebody who works for the IRS. A tax specialist, for a lawyer to call himself a tax specialist, he has to be pass a test, has to have had a certain level of experience, and then they can refer to themselves as a certified tax specialist.
Is there does the IRS or the Franchise Tax Board talk to your representative whether they are board-certified tax specialist, even a CPA? Do they have to be, or can anybody negotiate with these guys?
In order to represent somebody before the IRS, they have to be either a licensed attorney, a CPA, or an enrolled agent, somebody who's passed an exam with the IRS.
So you can't be your own lawyer, in other words, in this case. All right, what is going to land me in tax court? You'd mentioned that they can put a lien on and where they might actually go and seize assets. Now, I'm assuming you go to tax court when they got everything you got to give and they want more. Or it's a matter of, are you now going to pay a penalty of serving time? How can you end up in U.S. tax court?
Well, actually, the tax court is the place where you go generally when you don't agree with the bill you got from the IRS. So our last caller said that he was notified that a settlement that he thought was not taxable was taxable according to the IRS. Now, if he disagreed and said, no, IRS, you got it wrong, then ultimately he could go into the tax court and he would have a judge decide who was right, him or the IRS.
And are these judges basically like a judge would be in a criminal case?
Well, they're appointed by the President of the United States.
Okay, so I take it they're unbiased is what my question was.
Yes,
there. Okay.
yeah.
Dennis Brager is with me, Brager Tax Law Group. Does the taxpayer advocate actually do you any good? Now, I know they got him at the state level, they got him at the federal level, and they're supposed to be someone you can go to when you are not able to resolve a dispute with the tax agency.
Yeah, so the answer to that question is it depends on the nature of the problem, and it depends on whether you're dealing with the IRS or the Franchise Tax Board. Certainly, the IRS taxpayer advocate is very good at unstraightening snarls. So, for example, we had a case a few years ago. The IRS had accepted an offer in compromise. They had agreed to take about $50,000 on a $300,000 liability. And the client, even though we had the signed documents from the IRS agreeing to it, the client kept getting bills and threatening letters from the IRS.
Now, wait a minute. So you say, by the way, 50 on a 300,000, that's pretty good.
Yeah.
Okay, and what do you mean you kept getting bills? You mean
well, notices from the IRS.
Even though the IRS had told them that
right.
everything was hunky-dory.
Yeah. We had the documents in our file, and we'd call the IRS, and they would say, gee, we don't know what's going on here.
Well, we're going to find out how that case turned out when we come back on Money 101 on KFWB News Talk 980. What is the trust fund recovery penalty? If you're a small business, you need to know. You want to be listening in the next 10 minutes. Can you recreate receipts if you don't have the originals when you are dealing with a serious issue with the state or the federal tax agents? Dennis Brager is here with me, Bob McCormick, on Money 101 on KFWB News Talk 980.
Money 101 with Bob McCormick. The news you need and the information you can use. Now, here's Bob McCormick.
And here's something you need to know. The California Franchise Tax Board, FTB, has a new program. They're sending the SSN, Social Security numbers of anybody who owes it money, to all the banks in California. Those banks are then required to let the state know if any of those people with those socials have accounts. We're going to get more on that coming up. Dennis Brager is with us. He was an IRS tax lawyer, now a tax attorney with a Brager Tax Law Group. Now, you had a client, you successfully negotiated a $50,000 settlement on a $300,000 bill. You thought everything was said and done. Yet he kept getting bills?
Yep, kept getting bills. The right hand just didn't know what the left hand was doing. And we called a number of times and just kept going from one place to the other. And finally we called the taxpayer advocate, and I was saying that that's what they're real good at, sort of unsnarling these right hand, left hand kind of problems, and they were able to put an end to the bills and get it back to where it was supposed to be. So that was, the kind of thing the taxpayer advocate can be very helpful with.
And that's a case where you had the signed document anyway from evidence from them.
Right, but we were, we kept couldn't get rid of it. What the advocate can't help you with is if you think the law is unfair. So if for example you're involved in an auto accident and for some reason or another those and you had lost wages and you had to pay tax on them and you said, gee, that's really unfair, that's not something the taxpayer advocate can help you with.
Gotcha. A lot of immigrants come into this country. They have money back home, money here. Tell us about those bank accounts. If those accounts have more than 10 grand, that's an important amount. That's an important level.
That's absolutely right, Bob. Everybody thinks of foreign bank accounts. They think of Swiss bank accounts. They think of the Cayman Islands, but and people that are trying to dodge their taxes. But in point of fact, there are a lot of people who For example, we had a client who moved here from Canada. He had retirement accounts in Canada and didn't realize that because he wasn't filing the right paperwork with the IRS that he was supposed to be paying taxes on the accounts in Canada that were tax-free in Canada. They were taxable here. And he was also supposed to be filing these foreign bank account reports. And didn't realize it until he was in the process of getting a divorce, and all of a sudden it turned out that it was a problem. And so the IRS has a number of different programs to alleviate these kind of penalties, and we put them in one, and we were able to solve the problem. But again, if you've moved here from India or Canada or Israel, you name it, and there's money at home, including so-called family money. A lot of cultures are different than ours, Bob, where, we tend to be pretty proprietary. Your money is yours, and your brother's your brother's, and your sister's your sister's. A lot of other cultures, it's what they call family money, and it's sitting there in an account, and maybe the eldest brother is managing it, but he doesn't really consider that his money. He considers that belonging to the family. Well, if it's in his name, the simple answer is he's got to figure out how to report that here in the U.S.
Wow. Now, that's something I didn't know. Let's take a look at some of the other points of amounts that you hear bandied about. $25,000 is one of them, but first I want to get back to the $10,000 because that's also an issue. If you deposit more than that in a bank, why should you maybe not want to do that? Not put $11,000 or $10,500.
Well, when you deposit cash, not checks, but cash, into an account, or you withdraw money from an account, and it's $10,000 or more, there's a report that goes to the Department of Treasury. And, if you're in a legitimate business, that's no problem.
Yeah.
You deposit the receipts from your restaurant, no big deal. Where people sometimes get hung up is they say, well, gee, I don't want this report. I've heard there's something bad about it. So I'm going to go to the bank, and every other day I'm going to put in $9,900. I'm going to get under that $10,000. And believe it or not, doing that is a crime.
Wow.
That you can go to jail for. They've got a fancy name for it. They call it structuring. And the bank is going to send a report. If the bank sees that kind of thing, they're going to send a report to the IRS, and they're very serious problems associated
Another thing
with
I didn't
that.
know. All right, let's talk about this Social Security numbers that the Franchise Tax Board is sending to the banks in California.
Well, that's a relatively new program, and in the past, people sort of felt, well, if I owed money to the Franchise Tax Board, I can always keep one step ahead of them. I'll put it in an account that doesn't draw any interest. There's no 1099 being generated, and they'll never know about it. California got pretty smart about this, and it's gotten much easier for them to locate bank accounts. The other thing with the California Franchise Tax Board is they now have the authority to cause the revocation of professional licenses for non-payment of taxes. So if you're a dentist, you're a doctor, you're a lawyer, if you manage to aggravate the FTB for long enough, well, you could lose the ability to earn a living. So getting more serious.
All right, let's take a look at the trust fund recovery penalty. And a lot of small businesses get into trouble if they don't pay the payroll taxes. And this is puts an individual on the hook, not just the company, right?
That's absolutely correct. If a company doesn't pay its payroll taxes, the IRS takes that really seriously, because that's money that was taken out of the employee's paycheck, and that's why it's called a trust fund. And if the company doesn't pay that over, then the IRS is going to come after what they call the responsible officers of the company. And that can be shareholders, that can be people on the board of directors, it can be the controller, basically the guy who or woman who is signing the checks and making the decisions as to who's going to get paid. Because it's usually a situation where business is bad, and the business owner says, hey, I'll skip it and I'll make it up later. And sometimes they don't make it up for years at a time, and it gets...
Okay, you mentioned the financial. They could be on the financial hook. What about, can you get jail time for something like that?
You can. It's not common, but if the amounts are large enough and it's something you've been doing over several years, there are people who do it for several years, close down a company, open up a new company, and start the whole process all over again.
Tax attorney Dennis Brager is with me on Money 101. Bob McCormick, KFWB, News Talk 980. That $25,000 level, why is that so important? I hear it bandied about that if you owe $25,000 or less, you can get an automatic plan to resolve your tax debt.
Yeah, basically, if you're below that level, you don't need to submit financial statements to the IRS, and in most cases, they'll give you a payment plan of 6 years, 72 months, just for the asking.
And are you paying interest on that? By the way?
You're paying interest, and you're paying penalties as well. It's not a free ride.
Right, and they give you time, I take it, based on your financial situation to pay on that, right? What about over $25K? Is that when you need a lawyer? I mean, that's what they all seem to say. If it's over $25,000, call me.
Well, between $25,000 and $50,000, there's a simplified amount of financial information that needs to be submitted to the IRS, and then when you get over $50,000, it gets more complicated, and there's more room for negotiation.
Okay, IRS employees may be handling your case that are not being reasonable. Do you have an option? Do you have a recourse? We find out with a former IRS agent, now tax attorney Dennis Brager, Brager Tax Law Group. And he's with me on Money 101 on KFWB, News Talk 980. Now, we know about the Franchise Tax Board, we know about the IRS and their agents, and we need to specify exactly what they can come after. Social Security, tax refunds, 401ks, other retirement pensions. You'll find out coming up next on Money 101. If you owe back taxes, you need to listen. Dennis Brager also on how to stay out of trouble if you think you might be doing something that could get you penalized. Coming up next on Money 101 on KFWB News Talk 980, the home of the Los Angeles Clippers.
Money 101 with Bob McCormick. The news you need and the information you can use. Now, here's Bob McCormick.
We're here every day from 10 until 2. We talk a lot about marriage, and we talk about what happens after things go bad. It could be that you've got a financial disaster in your family and one spouse did not know what was happening. Dennis Brager is a tax lawyer and formerly worked with the IRS. Tell me about the innocent spouse law and how often does this happen where, for example, one spouse gets the bad news that there was a tax bill due?
Yeah, unfortunately, it happens fairly often. One spouse isn't telling the other spouse about what's going on. We had a case a few years back where the husband was a CPA and he wasn't paying his taxes. He didn't tell his wife about it. And he managed to build it up into a situation where the IRS had liens filed against their home, and then he announced to her that he had decided after about 35 years of marriage it was time he wanted to call it quits, and he'd also been telling her for years not to worry about anything because she always had the home to fall back on, and now the IRS had it all tied up with a lien. And
tell me, did you resolve it? I mean, is she...
Luckily, we were able to resolve it. We were able to show that she was an innocent spouse, that she didn't know anything about what had been going on. There's a whole long list of criteria that you have to go through. It's not just as simple as saying I didn't know. Obviously,
and we know about the Bernie Madoff scandal and what his wife was saying. What about, though, the property, then, that if you are still in this situation, you might be able to keep property that was received by illegal activity? In other words, if that husband was cheating people, amassed this fortune, the wife did not know about it and thought he was a legitimate hedge fund billionaire, I mean, could she keep any of that?
Well, I mean, the problem here in California is that we have community property laws, and while in most cases that protects spouses, in some cases, creditors of whatever kind can go after community property assets. So that's just the way it is here in California, different in other states.
Okay, what are the tools in the arsenal of these tax agents who want to collect from you?
Well, it's a pretty long list. They can garnish salary. They can go after if you're in a business and your customers if your customers owe you money, the IRS could go to those customers and grab up what they owe you. In other words, levy on their accounts receivable. They can, if you're a doctor, they can seize your Medicaid receipts.
Okay, what about a pension? If I got a pension that I've worked hard for and, for many years toiled for that pension, and in the last few years hit those times where the bills were accrued and the tax bills not paid, they can go back and get that pension?
Well, it depends upon which agency and what kind of pension. So, first of all, the state of California, in general, cannot go after your pension.
All right.
That's protected. The IRS is not subject to those rules. And if you have the kind of pension plan, the traditional kind, you worked for GM for 30 years, and you don't have the right to pull that money out until you retire, then the IRS can't get to it. The bottom line rule is if you can get to it, the IRS can get to it. That's about as simple as it gets.
Okay, when does somebody need to hire a tax lawyer like yourself?
Well, I guess I would say certainly if there's a concern about criminal problems, that would be a good time to hire an attorney. And I would also say if the dollar amounts involved are substantial, something that it's going to be fairly ruinous to you if things go wrong. That's when I would say you really need to at least talk to a tax attorney and see if it's feasible.
Are the many cases where an IRS employee is just not reasonable and you can possibly get a change, or can you ask for a different case agent?
Well, it's pretty difficult to get a different person assigned to the case, but what you can do is virtually every decision made by an IRS employee is appealable to somebody within the agency and sometimes even outside the agency. So if you're being audited, you can talk to that person's manager. If you don't like what the manager has to say, you can go to the IRS's appeals division. If you don't like what the appeals division has to say, you can go to tax court. So virtually anything that happens at the IRS, there's somebody else you can go talk to. And if you keep talking to enough people, in my experience, certainly if you're right and you have a reasonable case, then you're going to get a result.
All right. Now, you are going to try to do whatever you can to keep that tax bill down. You might even file for bankruptcy or say you're insolvent. Does that work in some cases?
Yeah, it sure does. Again, like everything else with taxes, it's complicated. But basically, if the taxes are old enough, and they're income taxes, you can't do this with payroll taxes, but if they're income taxes, you can walk away from those when you file for bankruptcy. Now, if you have assets, then you're going to lose those assets. So generally speaking, bankruptcy is a good solution for somebody who has old tax debts but doesn't have very much in the way of assets.
All right, they can. I want to know the different ways they can come at you here before we end this with tax attorney Dennis Brager. We know that they can come after these accounts. They can come to your business and do an audit there and see your books. Can they do that without a court order?
Well, first of all, I mean, if the IRS starts an audit, then they have the right to see your books, and they'll first ask politely, okay. And if you don't want to turn them over, they'll issue a summons, and if you still don't want to turn it over, they'll go to court and ask the court to order you to produce the documents.
And the
on
state
pain
will
of
do the
going
same thing. State will do the same thing?
Yeah, pretty much.
Well, what if they're both going after the same pie, Dennis Brager? What if they? I mean, there's.
It's a really tough situation. I mean, if you owe both of the agencies money, and and they want the money. Unfortunately, these two agencies do not and will not talk to each other on that subject. I've often said I'd like to, here's $50,000. That's all my client has. You guys go in a room and split it up however you like, but they're not willing to do that.
Split the baby. All right, Dennis Brager, you can contact his office at Brager Tax Law Group. I'm Bob McCormick. This is Money 101. Every day we're here from 10 until 2, dealing with real money issues in Los Angeles and Orange County. Credit, retirement, tuition, taxes, you name it. If it's got to do with a dollar sign, we're on it on Money 101.